Thank you all very much for joining us this morning. My name is Steve McMenamin. I'd like to welcome you to today's event, which is part of the ongoing series of the Greenwich Roundtable. Our topic this morning, investing in commercial real estate, is a continuation of the session that we first held in 1998 and then in January of 2003. It was our search for uncorrelated returns that inspired those sessions.
Oh, well.
Still searching.
Oh, well.
Today our inspiration is good old-fashioned bottom fishing. And we've got two legends, two of the most accomplished practitioners to help us navigate what may be a very tricky strategy. I'll briefly introduce them after I say this. Thanks to viewers like you, we're able to continue the series. And our speakers' views are their own and do not necessarily represent the views of the board or the members. Barry Sternlicht is the Chief Executive Officer of Starwood Capital Group, a private real estate fund that was formed in 1991. Over the last 19 years, he structured more than 300 transactions with an asset value of more than $40 billion. Barry Sternlicht is widely recognized as one of the leading innovators in the industry. Locally, Barry and Mimi are more known for their humanitarian work with public television station Channel 13, the Juvenile Diabetes Foundation, America's Promise, City Cares, and the Bruce Museum. Barry grew up in Stanford and earned his MBA from Harvard. Sam Zell is chairman of Equity Group Investments, the private investment firm he founded more than 40 years ago. Mr. Zell is a legendary real estate investor, having built, among many other things, the Equity Office Group, with, at the time, 126 million square feet in 744 buildings, which in its heyday was the largest owner and manager of office properties and apartment buildings in the United States, before he sold it at the top to the Blackstone Group. A legendary contrarian buying at a discount when there are no buyers, Sam Zell is best known for improving his assets and waiting for a turn in the cycle. Sam is past chairman of NAREIT, a trustee of Chicago's Field Museum, an advisory board member of the University of Michigan, and a strong supporter of entrepreneurial education. And sitting to my immediate left, Ted Seides is the moderator of the Greenwich Roundtable today and head of investments for Protégé Partners. Ted, as you may know, is the chairman of our programming committee and is one of the most thoughtful limited partners in the business. Ted is in the business of seeding promising hedge funds, and I'd be remiss to remind everyone that Ted is in the second year of a 10-year bet with Warren Buffett. Please wish him luck with Warren, and let's welcome Ted as he sets the table for us this morning.
Thanks, Steve. I thought a little bit about how I could add the most value to the panel this morning, and it was abundantly clear that I could do that by saying as little as possible. So before I turn it over to Barry and Sam, what I thought might be interesting was to look back at some of the things that they said to us in January of 2003. And that moment in time, which clearly was the beginning of a debt-fueled boom and subsequent collapse in real estate prices. Barry at the time said, even though real estate fundamentals in this country are awful, you can borrow whatever you want. This is January 2003. The only opportunities are driven by leverage and cheap financing. At the time,
That's okay.
At the time, he said syndication is back, probably before it took the form of securitization en masse. He called syndication a dangerous thing for our business. The only way these guys will generate the promised returns is through massive financial leverage. Sam said we're in the first inning of this game, but with rate increases, inflation, and leverage on the rise, exit timing will be critical. Unfortunately, there were no representatives from Blackstone in the room at the time. He called Freddie and Fannie institutions more focused on volume than market dynamics, which is usually not a good thing. And lastly, in discussing what was then just called subprime, he said every time we reached out and provided subprime financing, we ended up with subpar performance. So if the comments they make today are half as good as what they said back then, we really won't have to do anything but heed their words for the next 7 years. Barry?
What would you like us to talk about?
Whatever you'd like.
So I suppose
we can talk a little about the commercial property markets, maybe the residential markets in the United States. In our viewpoint, we're investing about $3 billion now across hotels, global real estate, and we have a mortgage trust that we raised in August of last year, which is a blind pool or semi-blind pool. It's listed on the New York Stock Exchange now, and is in the lending business and making loans and acquiring loans in a world where debt and the debt markets kind of evaporated, particularly in the commercial property sector. So our business, and Sam, I think, will agree. I mean, commercial real estate, rents in office, retail, industrial are probably going nowhere for 3 years, while the demand-led recession clears the inventory eventually. So if you have 17% vacancy rates in markets and record vacancy rates in some cities, I think given what we expect the recovery to look like, which is Fed-induced, it's an economy on steroids. It's not. I read everything, and many people say, oh, it's just 2x the prior recoveries or prior recessions. It's different because you have this 7,000-pound gorilla playing in your sandbox, which is the federal government, which is going to have to go away, and the baby's going to have to walk on its own. So in my viewpoint, we're a great nation, but the damage we're doing to our balance sheet, the country's balance sheet, could be long-lasting. And if it is, the best we can hope for is some, over the term, relatively modest, maybe jobless or job-like growth, which is tough for commercial real estate. As long as structural employment's in place, it's tough for consumer sales or sales. And you see it in Walmart's numbers now, the unemployment rates in the States. So against that backdrop, we think all the equity in real estate is usually in the debt stack today, unless the asset's unlevered. The equity's in the debt. And so what we've been focusing on is buying debt, and we move up and down the capital stack depending upon, and what, you can make money even if real estate rents are flat. And even if, and I do think commercial property in the United States, and I can talk about around the world, certainly in London it's bottomed at the moment, but real estate provides a yield. And in a world with no yield, it's very valuable. And you're seeing a lot of money come out of the woodwork already coming buying assets. An office building in New York at a 6 isn't so bad when the 10-year Treasury is 3.7. And a lot of people are sitting on cash. They are bored of earning 20 basis points. And so they're buying multifamily properties at 5 3/4 yields again. So the commercial real estate market now, the problem is the rents are lower, and that was a property that probably traded at a 4 yield at the peak. So if it was levered, the value of the asset's in the debt. So the industry is like a backed up toilet seat right now. You have billions, tens of billions of loans everywhere that can't refinance, but it can pay its current coupon because a lot of it we just are involved in a bankruptcy restructuring, and the senior debt's at LIBOR plus 50. So almost anything can cover 60 basis points as an interest expense, but it cannot mature. So this is going to be like road rage. As these loans mature, the servicers and the special servicers are rewriting, and they're literally writing history. None of these indentures, they're not all the same. And none of them were really, nobody contemplated giving all this power to the special servicers who will decide whether the tenant is so underwater or the owner is so underwater. We have a mortgage on 666 Fifth Avenue. We own a piece of the first mortgage. And the guy's way underwater. And he's telling the servicer, I'm not putting any more money into this building unless you cut the mortgage down. So the tenant, you got a 100,000 square foot tenant just left. I'm not putting any more money in. So the servicer has to decide, okay, I leave the building empty and the interest reserve runs off in the middle of 2011, and then we have a foreclosure process, or I can go secure this tenant, but the borrower won't put in the money because he's underwater. He's always throwing good money after bad. How do I modify the mortgage? So you're going to see a lot of surprises, and you're in the second inning, first and a half inning of that. You haven't seen it yet because these loans, if you look at the amount of debt coming due in the next 4 years, it's like $1.4 trillion, $1.3 trillion, and most of it hasn't matured. Actually, 2009 was a light year. So you're going to see, it's going to be fascinating. It's going to be many years. This isn't going to be like the stock market turning around and going up 60%. Against the backdrop, I think, of properties not running away in value. The only asset class, I think, in real estate that will do better will be multis. but not this year. Maybe 11, 12. 50-year lows in commercial and multifamily starts. 50 years. That's older than me. That's old. And 1949 was the last time multifamily starts were this low. And the economy of the nation was a lot smaller then. We had a lot fewer people. So if you think like I think everyone would say, certainly that guy who was the guy from the Black Swan said, the shorting the U.S. Treasury is the easiest trade in the world. Everybody should be short the Treasury. If you think that's the case, then interest rates rise, people get stuck in apartments because you're not going to be able to borrow 99% to borrow a house anymore. So apartments we think are interesting. Having said that, they're pricing themselves that way. In the public markets, they are quite expensive. And if you think rates are going up, a stick multi, or it's 5 or 6% yield isn't that exciting when the Treasury gets to 4.5 and 5. I wouldn't say that's a significant enough premium unless you really believe rents will fly. And they could fly, but replacing multis is not that hard. And there will be construction lending again. It's still, you can't get a loan to build anything, so supply is benign in the United States, but it doesn't matter because demand is worse. And so you are seeing pockets of strength, and we've been investing ourselves. We've just bought a bankrupt home builder out of bankruptcy in Florida. We're going to flip about a third of its inventory to a major home builder at a significant, hitting our pro formas 3 years out. We only had one other competitor at the auction, John Paulson. So he was the only guy there. We had won the bankruptcy, the right to buy this company. It's called TUSA. We closed yesterday. So we think it's plus 30% unlevered IRR. And we're not thinking housing prices go back to where they were. We're just thinking land at $15,000 a lot is insane. But it's hard to find big chunks of land to buy. If you want to put out $3 million, you can buy 100 lots at $30,000 a lot finished. The reason that's interesting is that the lot costs $45,000 a unit to finish. So you're buying the land at negative value, which to me, if I had $1 billion in my kids' trust funds, I would buy land. Because the U.S. is growing. So it's not when you'll make money. It's not if you'll make money, it's when you make money. So for us, I think that's an interesting play. That's something we've been quite busy in. And we've also been doing some debt investing. But as far as buying fee property, it's brutal. We did buy an office building recently in London. Like Sam, we've been spending a lot of time in Brazil. Unlike Sam, we've not gotten anything done, although we've tried real hard. And we like Brazil. I've been in China, I've been in India, and my favorite of the three would be Brazil, probably because it's so much more fun to go there. But it's also the same time zone, which it's a big deal. I didn't really appreciate that until I was 48, which was last year, because it's a big deal. And it's a big nation, and it's not China scares the hell out of me. And we're not investing. We've been in China. We actually still have an investment there. We got out of one very successfully, and we're in another. But the problem with China for us is that they're making the rules and they're not telling you what they are. And you have
sounds like Obama.
I can't even argue with him. So, and I think from the entry you can get in, getting out is always an interesting experience. And if we are partners with a state-owned estate, everything's state-owned. So, and they listen to Beijing. So I find it very tricky. And if you're investing in property, the beta on that investment I think is too high. If you want to play China, play in the public markets. In my view, your liquidity is at least more assured. In India, India is an amazing country, but it's very slow. It's hard. And I think it's IRRs there are kind of an American fantasy because they have all kinds of zoning issues, and it's a family-run country. They're great family enterprises. It's not necessarily a level playing field. What they consider straight-up business maybe not be our view of straight-up business. And we've done a big investment in Mumbai. We're building an office building with Mukesh Ambani and the Chatterjee Group and Hirandani family. So we have all the right guys in India as our partners, and it's still hard. And then we're doing a large residential deal down in Calcutta, which is affordable, and it's doing both of these deals were done in 2008. They were like two of the three investments we did that year, or 2007, and they're both okay. So that's interesting because demand in India is pretty good. I mean, at different ends of the market, it's not a demand issue. It's more a timing issue and the difficulty of their system and the fight between the federal government and the states and local laws. It's just and lack of zoning. I mean, you can build it's Houston, and the entire country is Houston. You can build an office building in your backyard if you can get somebody to tell it's okay. So I think Brazil has so much going for it, it's almost painful. It's all good. I mean, it's good right now, and they haven't even gotten the oil out of the ground. When they get these discoveries out in the ocean, and this becomes the second largest producer of oil in the world, it's just ridiculous. And it's good now, and that is the best of left government. It's already left. How much, so they're bringing up the middle class while the rich, the wealthy are getting wealthier. And from that perspective, it's working for them. And they are spending money. They have a 200 million population. 180. And
growing at 6%.
And I can't other than the government interfering with the currency, which for a foreign investor is a little tricky. It can be quite volatile. It went from 150 to 260 back to 180, and then I think it fell 19% in a month. But long term, my other big problem is I wake up at night when I think about what would be obvious. We all knew that this was a debt-induced, and that's why we stopped investing. We went from 2005, $2 billion down to 2008, $100 million of investing. We stopped, and we lost every deal we bid on. That's why Sam knows he sold a portfolio of office buildings in Seattle. We bid, well, he didn't. He sold it to Blackstone. Blackstone flipped it. Our bid was $770. Goldman Sachs paid $1.1 billion. Our exit in 5 years was like $850 million. They paid $1.1 billion up front. They borrowed $900 million from CS. So the financing was 130 more, and our partner owned 5 buildings in the city. And I was terrified at 770. It was the most aggressive bid I ever made in my career. So happy to lose. So, I mean, what will be as obvious to me about the world, unfortunately, is that we're sitting here 98% invested in dollars. And one day, when somebody doesn't show up for our auction, like they didn't show up for the Greek auction or the Portuguese auction, or the Chinese, if you notice, they are not buying our debt, this dollar is in serious trouble. And the movement of currencies and the equation of global wealth, and we have to do a standard of living adjustment, whether we like it, if you wake up overnight and the dollar's down 40%, we'll be reading about it just like the debt markets. Right? If I said one thing, you'll say, oh, it was crazy. They're lending 99% of the house and lending you the interest and lending you everything else. Unless our federal government gets some resolve, which they don't seem capable of doing, and realize they cannot do what the spending. I mean, we get $500 billion here, $400 billion there. It's staggering. I was laughing about this jobs bill, which is now $15 billion. Well, that was like the overnight loans to Goldman Sachs were $15 or $30 billion, right? They're $25 billion of government guaranteed debt, but the whole jobs bill for the whole nation is $15 billion. So I'm a Democrat, but I'm a fiscal conservative, and there is no such thing in this country at the moment. And I'm quite vocal about that, as well as getting a national energy policy that's a lot more serious than whatever this thing is. So Sam, go with that.
Hey, Sam, before you take over, is there a question you'd like to ask Barry? Keep in mind, I'll ask him the same thing when you're done.
I've known Barry for 20-some-odd years. I've never had a question I wanted to ask him.
Come on. Where do I get my hair done?
Other than, when was he going to raise his bid on EOP?
That's true. He did ask me that.
I asked you that. That was the only question I can remember ever asking you. I think in many respects, Barry and I share similar views, but maybe with some different nuances. It starts with the fact that real estate, which everybody thinks is correlated to all kinds of other things, real estate was, and will be all about supply and demand. And if you look at the supply-demand scenario, for all practical purposes, there were no commitments made after July of 2007 for any new buildings in America other than multifamily. And by the end of 2008, construction financing was gone. And therefore, even on the multifamily side, where you had takeouts from Fannie and Freddie that were available, you still couldn't build anything. So we're now in a situation where we've gone almost 3 years without any new supply. And based on the economics of the real estate business today, it's very hard to visualize that we will see any new supply anytime in the next 2 to 3 years.
Because rents don't justify replacement cost.
Right. In other words, and so from that perspective, I'm much more optimistic about the U.S. real estate market, and particularly the institutional market. The other thing that's interesting is between 2000 and 2007, almost in excess of 60% of all of the institutional real estate in America traded. And all of it, or 99% of it, was over-leveraged. So as you entered the end of 08 or 9, or right now, what you have is you have the ownership of institutional real estate in America basically constipated. The ownership has no equity. When the ownership has no equity, the ownership does nothing and hopes for the best. And what that means is that a company like Eastdil, which is a part of Wells Fargo, and is the number one institutional broker of real estate projects in America, in 2008, its business was down 90%. In 2009, its business was down another 90%. Effectively telling you that there are no transactions that are occurring. And to some extent, that really raises the question as to what really values are or are not. Because, in effect, if you have 1 or 2 transactions in a year in a market where we're used to 500 transactions or 1,000 transactions, I'm not sure that reflects much of the market. I also think that this real estate scenario or recession or whatever you want to call it is very different from most of the others, not all of the others. The last time we had a period like this was 1974. Because in both 1974 and 2008, they were both demand-led recessions, not supply-led recessions. When I did Zelmero in 1989, I looked out on the horizon, and first of all I saw were cranes. Second of all, I saw office buildings all over America that were under construction or just finished and a quarter filled or not filled at all. That's a very, very different scenario than what you see today. There are very few cranes out there. And to a large extent, the issue on the office market or various other forms is really demand. And can it fill up? My own judgment is that over the next 3 years, we will see most of the vacancy factor in U.S. real estate get absorbed. I think it'll get absorbed at probably 20 to 30% below the rates that were originally envisioned when whoever it is who bought the real estate or somebody appraised it. That creates the following kind of conundrum. You have loans that are maturing. You have buildings that are, to some extent, getting better. And yet, the cash flow from those buildings can no longer support the debt, let alone the equity. And I think the solution is not going to be wholesale liquidation of these portfolios. I have a nickname called the grave dancer, and I have been telling everybody who would listen to me that there ain't going to be no grave dancing opportunities this time around, maybe with the exception of the hotel business, because the hotel business has to be marked to market every morning, whereas every other form of real estate benefits from lease protection and the credit of others. I believe that with the exception of hotels, I think we're going to end up with dilution being the solution. Meaning that Mr. A owns an office building in New York City. The building is now, approaching full. Maybe it's got a 4% return. It was supposed to have an 8% return. And the equity is worthless. The mezzanine is worthless. And the first mortgagee is underwater. And an institution will come in and provide 20% of the debt in the form of a capital contribution that will pay down the first mortgage to an appropriate level of exposure. And then effectively the current owner will retain nothing other than a hope certificate. So maybe the institution will put money in and they get a preferential return, a preference on liquidation, and the owner will preserve his tax basis and preserve the fact that maybe it'll happen. And if it does happen, he's got some kind of a piece of the action on the other side. I think what I'm suggesting has very, very significant implications for the banking system, because there's been an awful lot of discussion, from all kinds of real estate savants like Wilbur Ross, who recently said, commercial real estate was the next shoe to drop. I told Wilbur recently that if I had any questions about the steel industry, I was going to call him, but I suggested that maybe he ought to call me if he wanted to opine on the real estate industry. But I really believe that the expected losses from commercial real estate lending are going to be dramatically lower than everybody envisions. Now, everything I've said has been conditioned with the word institutional. And I have to make this enormous distinction, because effectively at the top end and of the high quality properties, I believe that some form of dilution scenario is what's going to cure the problems. I don't think the wall of maturities is of any meaning whatsoever at the moment, as long as the properties can pay currently. I remind myself that in 1990, I made a loan with a bank on a big shopping center. 90 days after the loan was closed, the officer from the bank came to see me. And he said, we closed that loan. And then a couple weeks later, the controller of the currency came in, and he didn't like our values, so he knocked them down. And so therefore, you got to put up another $25 million worth of equity. I said, great. Are you going to lend it to me? No. Well, where the hell do you expect me to get it from? But the bottom line was that effectively the government came in and said, yes, the loan is current, but in our analysis of exit termination, you're underwater. Therefore, you got to take more reserves. You got to take a bigger hit. This time around, the controller of currency comes in and says, how much was the payment last month? What day of the month did you get it? Oh, you got it? Good. That's a loan that's okay. And that has led to pretend and extend, where basically everybody is, quote unquote, deferring maturities.
Or amend, pretend and extend.
Amend, pretend and extend. But whatever it is, the reality is nobody sees any benefit in taking action. And, the other side of the coin is that the assumptions in talking about commercial real estate always seem to assume that the owners will just sit there and, wait for the trap door to open and the noose to go around their necks. Well, I don't know whether you know anything about real estate guys, but real estate guys who own, institutional real estate are going to fight like hell to preserve the ownership, whether it be through bankruptcy, whether it be through lender liability lawsuits, whether it be through things we haven't even come up with. And so the result is that the ability of the lenders to accelerate gaining control, I think is limited. Their desire to do so is limited. And the result is that I think we're going to roll forward for the next 2 or 3 years in a scenario where demand is returning. The buildings are, quote unquote, filling up at lower rates than expected. But I think that from an equity point of view, the owners are toast with a hope certificate. I think the banks in the major institutional assets are going to be fine. The other side of the coin is the amount of, I don't even know what the word is, crap.
That would be inclusive. Yeah. That works.
Now, if you go into, I don't know whether you might have noticed if you did happen to watch the president on his State of the Union message, he said he was going to give $30 billion of new credit to community banks. That's like riding on a train into a boxed canyon and accelerating on the throttle. The detritus that exists in the small banks or the medium-sized banks is so horrible you can't even imagine. You have construction loans, you have land loans, you have financing on 15,000 square foot buildings in Peoria. If you were to sit back as a real estate pro and you were going to say, what does the future of commercial real estate in America look like? It certainly continues to be one focused on 24/7 cities. It continues to be a reversal of that trend we had in the 70s and early 80s of, moving American Airlines to Dallas and in effect, I think that's totally reversed. And therefore, the loan losses that exist in what I'll call the hinterland are very significant. Now, it's possible that that those losses will start to come to the forefront, and I wouldn't be surprised if the assumption is, well, if the little bank in Atlanta's got 80% real estate assets all going up in smoke, then so too does J.P. Morgan or somebody else. Not true. So I think the distinction between those two positions is extraordinarily relevant. I think the other thing that's both impacting the overall economy and very much impacting the real estate business is I don't remember at any time in my career where there has been less confidence in what the federal government does or does not do, and less visibility of what they can or might do. I think this is having an enormously negative impact on all business in America.
He's from Chicago, by the way.
Yeah, I'm from Chicago, and I've had Barack to my house for dinner, so I know who from whence I'm talking. But
did he have a food taster?
He did. But when it's all said and done, I think that this level of uncertainty, unless resolved, unless the American people or the business community is convinced that radical solutions are off the table, I don't think anybody is going to make decisions. 10 days ago, I was at the White House, and I met with Rahm Emanuel, who was head chief of staff and an old friend of mine. And among the other things that I told him was, I said, Rahm, you guys are now talking about a jobs bill. And you know what? I am your jobs bill. I create more jobs than Jeff Immelt and Fred Smith and all the rest of the lackeys that he paraded before the country 2 weeks ago, because I'm an entrepreneur, and I start businesses, and I build businesses. And I want you to know what I've done with my money over the last 12 months. I've bought distressed debt, and I've invested overseas, period. Now, if I'm at all indicative of what's going on, we have a true crisis of confidence. And until we reorder Washington and give some people, give everybody a better sense of what tomorrow might be, I think we're going to continue to be in this status of less activity than we need for a full recovery. As far as investing overseas is concerned, we attacked that challenge beginning in about 1997. Our thesis was that the equitization of real estate in the United States was an idea that was so powerful that it would pervade the rest of the world. And so we went out and we looked for opportunities to create platforms. We did not understand how anybody could go buy a building in Tokyo or a building here or a building there. That didn't make any sense to us. And consequently, we built a portfolio of companies around the world that are all in one form or another real estate related. Our biggest involvement is in Brazil. Barry was nice enough to give me a compliment about how terrific Brazil is, but it's really a very simple story. You got 180 million people. They're growing at 6%. The country has elected his leftist, and we like him. He's a fiscal conservative and a social liberal, and the combination has worked out extraordinarily well. The country is food self-sufficient. The country is energy self-sufficient. And the other piece of Brazil that we've really come to appreciate is it also has an executive class. One of the problems, I mean, we made a major series of investments in Mexico that were very, very successful. Our ability to grow those investments was limited by the fact that you couldn't find local talent. To the extent that the locals went to Harvard Business School or Wharton or got the real kinds of education we needed, they all went back to their families and worked in their family businesses. The ability to recruit out of families is non-existent. The ability to find an executive class that's capable of, in effect, taking on a challenge and making it work is very limited in Mexico and very available in Brazil, where we have literally built companies with executives that we've recruited with no family ties or anything like that. We think that Brazil has a lot more to go. We are the largest shopping center owner in Brazil. We're the largest housing company in Brazil. We're the largest real estate finance company in Brazil. And we continue to expand our involvements there. And understanding and never forgetting that when you invest outside of the United States, the number 1, 2, and 3 most important things is who's your partner. And the fourth one is who's your partner. Because the reality is when you go into emerging markets, you have to go into them with your eyes wide open and recognize you're trading growth for the rule of law. I never want to, quote, enter a court in any of the markets that I'm investing in, simply because we just, you don't have a chance, or very limited. And the only real example we ever had of that was in Mexico, where the government expropriated a business from us, and we started a NAFTA process, and then sued the government. And the government paid us $100 million and gave us our mills back because that's what the NAFTA Commission was just about to rule on. But without NAFTA, it would have been, a waste of time. We've invested in China, as Barry has. We still have investments in China. It's very interesting because I think one of the real issues in China is the fact that the Chinese companies are driven by first-time entrepreneurs. They are stubborn.
Rich.
And you talk to them about transparency, accountability, predictability, and they say, I don't speak English. And I think that until the Chinese market matures and you start getting professional executives as opposed to entrepreneurs who frankly have been through hell to get to where they got to, I think it's going to be a very difficult market to invest in. We're also investing in Vietnam and in Egypt and in various other parts of the world because that's where the growth is. And as far as the United States is concerned, I'm not a pessimist. I've historically had a great faith in this country, and my faith in it continues. On the other hand, I think we are heading down an impossible elevator shaft, and we have to, in effect, exert our own fiscal discipline if we expect the rest of the world to treat us accordingly.
Let me fill in a few. I was pessimistic as I talked about the overall asset class, and I believe in the entrepreneurialism and the optimism of this country if we don't shatter it with what's going on with the federal government, which has never been less popular with the American people. But it is, I started my firm in 1991. We did it when the RTC was being born, the Resolution Trust Corporation, for those of you who aren't old enough to know that, what that was. It was collected all the assets of the savings and loans that had failed. And I'm the most positive on this asset class that I've been since 1991. So against that terrible anemic demand, which I don't think will be as strong as Sam thinks, probably I'm not as optimistic about the demand scenario. Why? Why is it interesting? Okay, first, replacement cost. You can buy stuff in the U.S. that, like I talked about, our land below the value of the land. The land's free. It's hard in a growing economy to lose money if you find the right land in the right places. You do not buy lots in Detroit. You don't actually buy them in Clayton County, Atlanta. You buy them in Forsyth County, Atlanta. Clayton County, which is by the airport in Atlanta, housing prices have dropped from $140,000 to $30,000. In Forsyth County, they've gone from $241,000 to $233,000 over 5 years. So this is when you invest in real estate, you can read everything you want to read, but you find the cracks like you do finding a stock. You find the places where common views are actually keep people away, and you go find the opportunities in the market to deploy capital. I think at asymmetric risk, unbelievable upside versus downside. The biggest investment we made last year, we bought the biggest distress sale of the year was a deal from the FDIC. So the FDIC has replaced the RTC today, and anytime the government gets involved in anything, there's great opportunities. So I learned it from my former boss Neil Bloom, who was awarded a cellular license, and he made more money on his non-real estate investments than he did in his real estate investments. But so when the FDIC got into the real estate business again, and they're going to be in it for a long time, as they take back all these regional banks and small banks that Sam talked about, which really are bankrupt. Here's 2,000 banks. We've been trying to buy a bank. If you look at any of these banks and you think they have a 10% equity, if they're well capitalized, they have a 10% tier 1 equity. What isn't down 10% if they have a real estate book? There's nothing in the world that isn't. Everything we think property values, and NAREIT will tell you down 40%. If you run the math, they're down 35, 40%, and they own the shit. They really owned all of the crap, as he said. If it was really good, it went into securitization. If it wasn't that good and was in transition or was a smaller asset and wasn't pretty, it was parked at the banks, the commercial banks, the 19 banks that they saved. And then if it was trashy and nobody wanted it and couldn't go into securitization, it's in a regional bank. And it's there. They have BB&T has billions of land loans. I don't know what either, and they have no losses. So we don't know how that's possible because we know all the land around them and they have loans on all of it. And
they were smart.
They were very smart. They pretended, and the government has said, don't take any losses. The guy's paying, and I think the government is basically just looking the other way because they can't handle it. The FDIC's broke, and they can't handle taking all these banks back. So they're taking them back 7 a weekend. And, they try to find another bank. New York Community Savings buys AmTrust in Ohio. I mean, it's a little bank from New York. They're recapitalizing New York Community Savings Bank by giving them an assisted deal on a bank in Cleveland. And that way they take a failing bank and pump it up with basically a TARP funding, but it's disguised as FDIC assistance on the loan losses, and pump it up, and they'll get back to that one later. They're going to go save another one. So replacement cost. You can buy stuff in the United States, office buildings, at deep discounts to replacement costs with land valued at zero. Actually, it's unique to the U.S. You can't do that in London. You can't do that in Paris. You can't do it in Moscow. You can't probably do it anymore in Istanbul. And you can't do it in Brazil. So That makes for interesting risk reward. You have positive leverage. The only leverage you can have today is positive. If you can get any debt at all, the lender's going to want debt service coverage. And there are loans being made now, and we're making them ourselves. And it's competitive. Why is it competitive? There actually isn't enough debt, but there aren't enough transactions. So in 07, 08, there were $400 billion of transactions, debt issuance a year. Then it fell to 40. 40 is about what the life companies were doing of the $400 billion back then. So the life companies are here, and they've never seen spreads like this. They are out like in force trying to make loans, and they're looking at spreads to treasuries that they've never seen. So, and they got no competition. There's no CMBS. There's no commercial banks. Bank of America's made about 2 loans worth 2 cents. J.P. Morgan, which they get angry at me for saying, and I keep telling them this is a badge of honor. They hate real estate. They don't have a lot of big real estate loans. So look, I got a call again that I said that. But they don't do commercial real estate lending. You have 2 giant banks in the U.S. that have all the real estate exposure. Wells Fargo, $145 billion. A lot of it came from the Wachovia acquisition. They're actually and BVA, $125 billion and $145 billion. And those 2 guys they have most of the exposure in the banking sector. Then you have banks like Regions, Synovus, which are technically, in my view, insolvent, but the government doesn't really want to take them back and doesn't know what to do with them yet. So they're letting them recapitalize. That is one of the key reasons the Fed is keeping rates low, is letting the banks earn their way out of this. Time does heal the banks. And it's a race between asset bubbles, and the fact that guys are coming and buying property, probably at yields they shouldn't be buying them at, just because cash is earning nothing and treasuries are nothing, and letting these banks, the whole banking system, recapitalize, buying agencies and just doing it by borrowing off the Fed funds rates at near zero. So so you have positive leverage. You have the FDIC is going to be a big seller of real estate, and we bid a portfolio of $1.3 billion loans last week in Atlanta. We bid 2,200 homes at $50,000 a house, new houses. I don't know how you could lose money. By the way, we didn't win it. Lennar won it, and they paid a lot more than we were going to pay. Because Atlanta is sort of a Dallas with hills. Values don't go anywhere. But you can trade the difference. If the average home price today in Atlanta is $120,000, so you pay $50. By the time you service it and go through courts and bankruptcy, you're at $70, and you make $50,000. It's a business. It's a tough business, and it's interesting from risk reward, but you're not going to make a lot of whole dollars on it because the house is not going to be worth more than $120,000. Lack of competition. Our business has changed a lot because the street has decided that they didn't know how to do real estate. So Morgan Stanley's $9 billion fund, was marked down by them by 93%. Right?
That's an optimistic.
And that's an optimistic mark. Colony marked their $4 billion fund 80-something 4%, 83%. Whitehall has been shut, which is Goldman Sachs' funds. Lehman Brothers is out of the business of lending guys 97% of cost. Bear Stearns is gone. Merrill Lynch is gone. So for us, there are 4 or 5 large independent, I'd call opportunity funds that are left, and we actually are solvent, which is shocking. But we didn't do a lot of our funds were 65% leveraged before. The new fund is like 23% leverage. So if you have less leverage, you get to live for another day. And everyone's been hurt because you couldn't avoid it, just like you couldn't avoid it in the stock market. But the lack of competition, lack of capital is good. What we're seeing on flow of funds, which is into our business, because I'm finishing fundraising, high net worth families are back. They smell a really interesting opportunity. And probably the biggest windfall for commercial real estate in the United States, foreign investment in the U.S. They love this country. And the Chinese, as Sam knows, because he spent time there, they will come over here, and through me or Sam or 17 other guys, or one way or another, they will find a way to buy our cities, states, golf courses, just like the Japanese did in their day. They don't need any more T-bills at zero, right? And if they relax FIRPTA, which is a Foreign Investment Practices Tax Act or something like that, yep, which they're working on, which is a prophylactic to foreign investment in property, direct property in the United States. And they're talking about there's a bill introduced in Congress. I think you will see the Chinese already. Bank of China has made 3 loans that I know of in New York City, and they're going to be a large player. And the Chinese are looking at 50-year hold periods, right? If they can buy, if Sam could find them or I could find them, a trophy office building in New York City, if it's yielding 4 or 5% and looking at $2 trillion of treasuries earning 2, they'll buy it. And they'll put it away. It won't trade, by the way. I doubt they'll trade it. And that could have big impact on a thin market because there aren't a lot of trades. And people will begin to price like we did in the 70s and 80s off the Japanese price per building. They'll price off the foreign investor, the Germans, And the Arabs will be here. I mean, the oil, I don't know what your view is, but they're not broke. I mean, Sam spends a lot of time. I've been in Abu Dhabi, spent a lot of time in Bahrain. These guys have a lot of money. They're just a little nervous. They got wiped out. But they have a lot of money, and it comes in every day. And again, against treasuries, property looks really exciting. And these countries like property. Like, they don't understand investing in Dell, right? They don't understand a business like that can come and go overnight. They really like the edifice complex, I call it, right? They love buildings, and they get it, right? So this is, it's a turn on to. We own a lot of hotels in Europe, and we're selling some of them, and we get a lot of bids from Egypt, from wealthy guys, and they're not from the U.S. There's a lot of money around the world. There's a lot of wealthy people, and a lot of them want to own what Sam called institutional quality assets in major gateway cities. Some of these people don't know anything outside New York. Right? It's New York and all other. Maybe it's New York and Washington and all other. But that's the market, and I think I'm bullish on investing in the asset class, but I think your underwriting has to be very realistic. When we model land, we have 3-year holds at zero. In fact, we usually thought the prices would drop, housing prices would drop. I do think the housing market is settling down, and I think you've seen the worst of the housing market. We're not making enough houses, actually. We're not constructing either multifamily or single family. And so I think market by market, you're going to see, you're going to start seeing starts. The country is, if you look through the data, the inventory is being absorbed very quickly. And there's a panic almost in certain communities. We bought land in May from the FDIC in the Inland Empire of California in a place called the Dairylands, which I don't even know where it is, but it's in Riverside. We paid $30,000 a lot. We just sold the whole thing for $100,000 a lot to a home builder in 9 months. And it was a small deal. We put $5 million in. We'll make $10 million on it. But it was unlevered. And you can make money in crazy markets like this because everyone else is reading the newspaper, right? If you do your work, which professionals, we have 140 people, and we do our work. My partner in San Francisco said, I thought Dairyland smells like cows. I don't want to touch it because this is the hottest place on earth. I said, okay. And we did the deal, and he flipped the lots, and I couldn't believe it. We had 7 homes that we thought we'd sell for $1.8 million. We sold for $2.7 million. That came with the deal. So they're little deals, but you can make money in these markets, and you can make money because the last thing, as the stock market goes up, our pension fund clients are completely misbalanced again. They said they were overweighted in real estate, and I just kept telling them, just wait. So the Morgan Stanley marks came in, and they're down 90%. And then the stock market went up, and I'm out with one of the largest institutions in the United States that invest in property. So we have $7 billion to invest because they have an allocation, right? And they got to meet their allocation. And all of a sudden they're 3% in property because everybody they invested in is down 90. So and the stock market went up, and so they said they're like, we got to invest $7 billion. And now what are they going to do? They're going to buy good real estate, virtually unleveraged. They're going to take everything they did leveraged, wipe them out. So even though they have 100-year lows in interest rates, they'll do it unlevered. So they'll do that core. So they'll lose the same absolute dollars, but less on a percentage basis. Slower. So you're going to see, and our job is to set our properties up to feed those guys when they return to the market.
I have a couple of comments. First of all, the key thing that Barry just said, and you know, I've been in the real estate business for 40 or 50 years, and the number one criteria of value that is in my world has always been replacement cost. But it's always been replacement cost without land. Land is an accordion. When we sold Equity Office, somebody paid us $1,500 a square foot for an office building in New York City that cost $500 a square foot to replicate.
The building.
To build the building only. And this is 2007. So that means the land was $1,000 a square foot only in terms of the total cost of the asset. If you go back 7 years to 2000, land was selling in core Manhattan, Midtown, for anywhere from $50 to $100 a square foot. So in 7 years, the cost of construction probably went up 20%. The cost of the land went up 700% or 1,000%. that which accordions up to $1,000 a square foot can very quickly go back to $50 a square foot. When Barry's talking about buying lots, and he says it's below replacement cost, what he's basically saying is that the cost of improving the lot, sewer, water, streets, sidewalks, is $45,000 a lot, and he's buying the lots at $30,000. So what he's really doing is he's buying land for $0 and buying improvements at 60 cents on the dollar. I think it's important not to assume that the FDIC in 2010 is the same as the RTC was in 1990.
Much smarter.
Well, that's a different story. But
no,
the S&Ls held primarily a vast array of apartments that were institutional quality.
You bought them.
And you bought them, and then you sold them to me. But the bottom line was, this time around, the quote-unquote FDIC packages have raw land, condos, unfinished, 2,000 square foot office buildings. I think the quality of the real estate inside of the FDIC is materially worse than what was in the RTC at the time. We also haven't talked about REITs. And when we started the modern REIT era in 1993, and Barry and I were working on that at the same time as well, the big argument was, when it's all said and done, access to capital is what this is all about. And the thesis was that whereas the real estate industry had historically gone from feast to famine in terms of availability of capital, the equitization would effectively create that scenario. Well, in March of 2009, we really got a test of whether that's really true. And what we saw was that dilution was the solution, that effectively the public markets gave the REITs more money, a lot of more money, yes, at very cheap prices. But effectively the question was, would you rather be diluted 15% or 20%, or would you rather continue to be in a position where you couldn't do anything because you, in effect, had maturities coming up and giant risks? The result of that, I think it was $40 billion of roughly new money that went into the REITs on an average, in most cases, 20% dilution. Almost without exception, the stock prices went up more than 20% when the risk of not having enough liquidity dissipated. So I think the REITs have really shown that they are a long-term, stable, and viable methodology for participating in real estate, and likely to be much more stable going forward, as they have been in the past, compared to the private sector that, in effect, has much more volatility to it.
Huge premium for liquidity.
Right. I want to add another comment about what Barry said and about the single-family house market. Prices in London for housing have gone up in each of the last 3 months. The most recent, some of the increases were even double-digit. And it's all being driven by no supply. Now, I know you all can't even imagine a situation here where we have a quote-unquote shortage of supply of single-family homes. But I think you're going to see that start to occur in markets across the country. Everybody talks in terms of the single-family market, in terms of the statistics. How many foreclosures, how many this, how many that. But they don't focus on where. So if you go to Vegas, which is the number one foreclosure state in the United States, it's horrible. If you go to parts of the Inland Empire,
it's
horrible.
but not the Dairylands.
But you go to Miami, and there's maybe 8 or 9 years supply, and yet in the rest of the markets, the supply-demand scenarios are nowhere near, not even close to what they are in these overexposed pockets. And so, again, I think it's very dangerous to make broad assumptions, and frankly, I think it's very dangerous to predict where the single-family market goes, for that matter, because I think the supply-demand numbers are much better than current statistics would also suggest. And lastly, I'd make a comment on Barry telling you that you can make money by buying lots in Riverside, California for 30 and selling them for 100 in 180 days. I think the only thing wrong with that statement was that it began with you. And the answer is no fucking way. Barry could do that. Other very sophisticated real estate pros can do that kind of stuff. Outside of that limited group of people, we're going to have another, disaster of all of the, grave dancers in training. I guess led by TPG and Washmeal, where too early, too much, and then too late.
So, thank you, I guess.
No compliment intended.
I do want to say I've been doing this for 20 years, and we bought last August, I think it was in October, the assets of Chorus Bank. Chorus Bank was a Chicago-based lender, and they were taking over the FDIC. What was unique about Chorus was they had 102. The book was 102 loans. That was $4.5 billion. The little package of Atlanta loans that we bid on last couple of weeks ago was 1,300 individual loans, average loan balance less than, I think, $100,000 or something like that. So it's a totally different business. These loans were $50, $60 million. All of it was basically construction deals. 20 of them were already REO, meaning we got the buildings. About 40 of them we thought would stay performing. We have loans, first mortgages on office buildings, 5 of them in D.C. And but what we bought at the end of the day was 12,000 condominium towers in New York City on 56th, between 6th and 5th and 6th, and the Centurion, it's an IMPay building, a building down near Gramercy Park. By concentration, the biggest pool of assets the way we've had them was Los Angeles, which is actually going to have a shortage of housing in downtown. They've actually metamorphosized now. I can't believe it. I've been going to LA for 25 years with the new entertainment center down there that Phil Anschutz built. It's a hot market. They're actually opening everything.
I think there's demand for another 3 buyers.
At least. So maybe. But anyway, they're selling at $400 a foot. So we paid $123 a foot, which is 37 cents of construction cost. And the government financed that, half of it at zero. Right? They gave us, we paid $2.7 billion for $4.5 billion face. They gave us $1.35 billion at zero, which was very smart because they also took 60% of the equity. So that's the difference between today and yesterday. So we're working for you guys. We're working for the taxpayers. And they rented our shop. And the only thing they pay us is a management fee. And then the debt is the first thing that gets paid off. But from my perspective, it was the most exciting investment I made since the RTC days because we have no downside. And prices could fall 40% from $123 a foot, which is $80 a foot. For buildings, the hard cost would be $200, $300, $400 a foot. And to break even, the way the math worked in the deal, and with the performing loans that are performing. So, and the results have been, we've sold 900 condos in 3 months, like 4 times the pace we thought. You can sell anything you want in this overbuilt Miami market to Brazilians, Mexicans, Peruvians, guys from the number one country is Venezuela. If they have a shitty government, they're buying property in South Florida, all cash. $200 a foot in parties. They have parties down in Bogota, Colombia, and everyone buys a unit in a building, and it's not even part of the United States, Miami. It's like it's amazing, and these buildings are nice. They're actually nice, some of them. One of them we're going to Cristo. We're just going to put wrapper around it, and we'll deliver it in 4 years because it's beautiful. But why sell it today? And because we have 0% financing, we just wait. So we thought it was really interesting. We've probably raised our IRR 700 basis points since we did the deal. Just the pace of things happening is so much faster than we thought. And But there's stuff like Vegas. I mean, Vegas, Sam mentioned, there are good places in Vegas, but a lot of Vegas is a catastrophe. So that was a unique deal. We're only aware of like one other bank in the U.S. that has a portfolio like that's going to fail. Most of the stuff that they have, this sale is like 7 regional banks. It takes them. There's a deal coming out on Silverton Bank. I mean, I think there'll be 7,000 bidders. I mean, there are a lot of people who have decided that this is the way they're going to earn their nickels, these amateur grave dancers. And you see a lot of stupid bids. There was a deal done with Deutsche Bank auction. We thought it was worth 18 cents. Deutsche Bank was hoping to get 25. Somebody I won't mention paid 44 cents. That doesn't even exist on the page. That wasn't on the pro forma. So there are guys who are being seduced by this 0% financing, but if you don't get the market right, you just won't make any money. You may not go broke, but you'll work really hard to make nothing.
Yeah. Questions?
Go ahead.
I know you guys are real estate guys and not economists, but throw a little inflation in there.
Oh, that's the wild card for us.
That's our business.
Yeah. We win.
I think that it depends on what kind of inflation. I think that if you have, quote, slow erosion inflation, i.e. money velocity is keeping inflation in place today, and let's say that money velocity stays slow, then you can't have a lot of inflation unless you have money velocity. Obviously, going back to Barry's first comment about the U.S. debt, that to me, I mean, some kind of failure of the dollar, I think, could turn America into hyperinflation. And history says that in that kind of an environment, owning brick and mortar is good. Owning somebody else's fixed rate, owing somebody else long-term fixed rate debt is better.
You go back to when I started in real estate in '86, but you go back and look at the Forbes 400 back in the days of inflation. Everybody on the Forbes 400 was a real estate guy because they all had billions of fixed rate debt in Manhattan, and their buildings soared in value, and they were all rich. So if it happens again, and I think the only logical outcome to the spending of this administration has to be inflation. I don't know any other way we can. When they are creating an S&L crisis in the federal government. We're financing short the long-term liabilities, and he's borrowing at zero, $44 billion of 2-year at 88 basis points. I mean that's not going to last. There isn't enough demand in the world as other countries go into deficit and also demand credit and from the bond and markets, and liquidity begins to find other homes. I mean, I don't know. We're going to have. You're paying 4% on X trillions of dollars. I mean, you've structurally created deficits from now to the end of time. So if we don't get off of foreign oil fast, because as Larry Summers, I was at Davos in Summers. I had a session with 2 guys in Summers in the evening, and he said, "Oh, you mean we're borrowing $400 billion from the Chinese to spend this to pay the Arabs, basically?" And I said, "Yeah, that's about right." This is not sustainable. It can't be sustainable. Somebody's going to say uncle. And I would say the most interesting about Davos this year to me, if any of you were there, the Chinese were walking around like peacocks. They were strutting. I've never seen them strut before. I mean, they were humble and kind of quiet and meek. They would sit on a panel. A guy would say to the guy, "Well, you said 4 years ago you're going to rebalance that currency. How do we know you're going to do it now?" And basically he says, "You don't. We're not, we're the banker to the world. We're rich." And a lot of guys chain us. A lot of guys are very bearish on China. I wouldn't be bearish on China. I mean, China is the richest nation in the world, and they have brand new infrastructure. They have a business plan they're running the country like a company with a very good CEO. And they know exactly what they're doing. They're creating capacity. Too much capacity. They're not on the 1-year plan. They don't care about quarterly earnings in China. They're on the 50-year plan, right? They're doing the long-term thinking that governments should be doing, and our government is clearly not doing, right? And they are building capacity that what will happen here, and we'll come back in 2000 and whatever the year is. They will take all this great export that we think they're dependent on exports. As their middle class develops, they will turn all that capacity on their domestic demand, and they will say goodbye to us. and goodbye to buying our foreign debt, because they won't need us. And they will be delightful, and then you'll learn about all the problems that come from that. The Chinese it's a brilliant strategy. Seduce us with low rates, allow us with their fixed currency to borrow cheaply, import deflation, keep prices low, right? And then we send trillions of dollars over there. They industrialize, they create wealth for the middle class. Then they turn all of that, those middle class start buying. They're trying to get them to consume. Their bank lending has exploded. And then they'll absorb all that capacity for domestic demand. And then they won't be dependent on foreign exports. And you think they're difficult now, they'll be very difficult. And we will have to raise rates to seduce capital to come here and pay for our spending habits. So I wish I could be bullish about that. Honestly, I think I didn't vote for Obama. I actually didn't vote. I couldn't vote for either person. I knew how left Obama was. So I feel good about that, at least personally. But I'm just so disappointed because he had such a great opportunity. I mean, he really galvanized the nation. And I think the disappointment, it's like a euphoria to the end of, it's the other end. People are really, the nation could lose confidence because it is losing confidence because he's really disappointed such a broad swath of the population. And we don't, I'm not going to go into it, but you need a political speech.
The country wants a leader of all of the people. This administration has sent a message that there are winners and losers, and they're going to pick which ones those are.
And if you won before, you cheated.
Right. And by the way, and if you're successful, you were a cheater.
You cheat, or your ethics are misplaced, which is a very.
Or you
tough
probably
message.
went to a convention in Vegas.
Right. We should talk about the hotel business for 1 second. You want to do that?
Go ahead.
So there's nothing worse than a hotel business today, and it's I don't think there's anything worse because you can't, especially the group market. And if you go to resorts today, I mean, there are no groups, and now resorts I've never seen this. They're pulling the name resort down. Yeah. Right? It's no longer a resort because if it shows up on the P&L, and I think it's going to be a while before corporate America, even though they're rich, we're not talking about the stock market here. Companies are sitting on cash like they have never seen. But incrementally, they're doing what Sam's doing. They're investing offshore because why not? And we have a fairly high tax rate on companies too. So getting higher. So you're not seeing the group business come back in any demonstrable form. The transients are back. They're being seduced by low ADRs, low rates. But in fact, Vegas transient is up. People are driving to Vegas. You can stay at the hotels for $59. So I mean, it's a field day for transients. And they're also not traveling offshore because they don't feel like taking a flight and spending $2,000. So people are staying home. Plus the dollar at least was weak, right? So going to Canada got really expensive all of a sudden. Right? It used to be easy to go to Interwest, to go to ski. It was a bargain. Now it's like expensive. So guys are staying home. Transient business is pretty robust. The group business, I don't think comes back as fast as people think. I just think the companies, you think about who did that. Who did those groups that filled these hotels during the midweek, the big convention hotels, the Marriotts, the Starwoods. It was the pharmaceutical companies, it was the auto companies, and it was Wall Street. With junkets and for their high rollers, they're all sort of like in the penalty box. J.P. Morgan, my wife has an event space in Stanford that she runs. J.P. Morgan last year did their 400 best performers at some resort in Florida, and this year they did it at my wife's space. I think last year they spent like $2 million. I think this year they spent $9,000. So and Jamie Dimon was there. Jamie Dimon went to this like cavernous. I should advertise their place. It's very nice. But it's like a modern loft kind of thing. And he showed up, and so did Jimmy Lee, and the whole. And I was like, oh my God! When my wife told me they booked J.P. Morgan, I was like, I figured it would be like the accounting department from somewhere. But the head leaders showed up, and they did this event at her space, which is like and so companies are doing that, and J.P. Morgan's in good shape. So I think it's going to be a while. Having said that, when it's obvious it'll be too late. You can buy hotels and talk about replacement costs. There is no relevant replacement cost right now. And the market is overbuilt and it continues to be overbuilt because construction cycle lasted further than the office building markets. So you're seeing in some markets 5, 6, 7% new supply. That's going to go away because you can't build a hotel. A lot of people building small courtyards would have borrowed from regional banks that were not in business, no longer in business signs up. So I think you're going to see a very powerful recovery. I just think it's out further than the stock market thinks. And by the way, one other thing about property, all of our states are totally bankrupt. And the one place they can go is they tax Sam and I. Right? We don't vote. Buildings don't vote. Shopping centers don't vote. Houses vote. So they will increase property taxes because what else are they going to do? And that squeezes your margins if you're a property owner. And that could be ugly for public companies, our whole sector, right? Cook County, where he lives, I think is the highest real estate taxes I've ever seen. I mean, like...
Oh, no.
Well, in the
New
U.S.?
Hampshire's much worse.
Is it?
Oh, yeah.
I don't know any buildings
So
in
is
New
New York.
Hampshire. No, is it?
Yeah.
Per foot?
Yeah.
Okay, there. I don't know that. All right. Anyway, so values are going down, and everyone is out challenging the valuations for taxes, and that's fine. So they knock your value down, but they increase your mill rate, so you wind up paying more taxes than you were doing before. Cities can't afford to take hits to property tax payrolls, so that's a challenge. If you're in some states, they're not all created equal. Some are better than others, but that's something you have to watch out for.
I think that the hotel space is the only space other than land where there really are grave dancing opportunities. We just closed a deal where we bought nine Marriott Court hotels.
You did?
Yeah, we bought the debt.
Oh, the debt.
Yeah.
Oh.
We paid 42.
Because he doesn't like hotels usually.
we paid 42.5 cents on the dollar for the debt. Maybe the guy will make it. Maybe he won't. But, that's basically a loan-to-own strategy.
Okay.
And I think there in the hotel space, everybody's willing to take a hit. And therefore, you can, because in effect, the burden of owning an underperforming hotel is 4, 5, 6 times as bad as an office building or a shopping center because it has such a high break-even point. So there's going to be a lot of deals in that arena. And yet, interestingly enough, the hotel business, particularly overseas, is recovered quite dramatically.
Depending on where you are.
It continues to get better.
Yeah, depending on where you are.
Yeah. Well, if you're in Asia.
Yeah.
Not if you're in Europe.
Right.
One more question? Yeah.
Just kind of taking a look at what's happened in the last 36 months and a lot of people would say...
Excuse me, could you stand up? We can't hear you.
I think a lot of people would say that in the last 4 to 6 months, cap rates, especially for apartments and certainly core office and gateway cities, have come down, depending on who you talk to, good 100 basis points, maybe more. Do you guys think there's a short-term asset bubble?
No, because I don't think that cap rates have come down. Describe to me a color you've never seen. What kind of a cap rate is there on a building that doesn't trade? The reality is, in the last 3 or 6 months, there have been some transactions. And when the transactions occur, the cap rates are not terribly different from where they were in 2007.
Well, what I'm kind of comparing it to is the very small number of trades that occurred in the early part of 2009 when nobody was doing anything.
But this is where you really have to know what you're underwriting, right?
You can't make a market out of outliers.
So if Vornado sells a building in Washington D.C. which has like a 20-year lease to a single, it's a bond. It's not. They're buying a yield. The German buyer.
HBSC did the same thing in New York.
They buy a yield, right? HBSC sold their headquarters and we looked at the deal to an Israeli group. IDB Bank bought the former Safra headquarters just south of the library. The cash flows which happens now every 7 years, are reversionary. So a cap rate, like we buy a building, we bought these apartments in Raleigh. We think cash flows are going down. We were buying it at 8.25, so we can excite you. We're buying it at 8.25. That sounds pretty good, right? But we think they're 7.5 this year, right? So cap rates, no two are created equal, and there's so few trades that you can't say where the market is. So a multi in Washington D.C. today, if it's free and clear, will sell at a 6. I mean, because people will absorb, and everyone.
We just bought 900 apartments in New York City at less than a 6.
Yeah,
and it's a great deal.
Well, they bought it. First of all, you can't build them for what they paid for it, and over he's got a long-term horizon. He's going to make. I do think cap rates are very much more tied to interest rates now. So I think if rates do go up, cap rates will back up, and they'll be. There's not enough. I always tell our guys the flow of funds overwhelms fundamentals. I'm a fundamental guy, so I'm not good in the Emperor's Clothing part of the cycle, this cycle that Sam sold into, where guy buys at a 5 yield, sells to 90% leverage, sells to a guy at a 4.5 yield, who sells to a guy at a 4 yield. and you didn't do anything. You didn't even have time to change and it got a 60. We have guys in our business who made 60% IRRs on their funds because they bought it for a week. They bought it at 6 and sold it at 5 with 97% financing from Lehman. Right? So, I mean, that's not a business. I'd rather be in your business. I'd rather buy stocks. At least that's liquid, right? This is an illiquid asset you get stuck with. And that was musical chairs, and it ended. The music ended, the orchestra left the room. Right?
No, thanks.
Didn't mean to wake you up.
Mesmerizing is like focus.
Thanks very much. So while I'm talking, if you'll fill out the comment cards, Board of Trustees are going to meet here in the room right after this session. And I want to thank everybody. We went out with a plea. We're now 85% funded by LPs. And thanks to you, we're back in business. The other currency you can offer to us, in addition to a check, is helping us with best practices. I mentioned last month Ray Gustin is helping us lead the charge on our due diligence series. We're finishing up. We need some help on valuation and doing due diligence on hard assets, real estate, and venture capital. So if you have any comments or can lend a hand, get in touch with me. Speaking of real estate, we're subletting the offices for the Greenwich Roundtable. So if any of you want a hot backup site up in Connecticut, or you want an office for Fridays, we are actively marketing the space.
You better get it quick, because everybody knows there's no supply in Greenwich.
Just one thing about Greenwich, because we just involved with this building up on the avenue, which many of you must know, U.S. Tobacco. You know that Phil Duff signed a lease at $155 a foot. Right. It was rewritten at $85 a foot. So just to your point of cap rates, what cap rate are we citing? When Phil Duff was in or when Phil Duff was out, right? I mean, and the new space that will come available will be in the 60s a foot, 65. So that building, put leverage on that. And the one thing we didn't finish on, when Sam said there'll be a long cycle, 400, a lot of the stuff will just get extended. I didn't say that. And a lot of the loans, the GGP bankruptcy was seminal, in my view, because they took, not only did they extend the paper 8 years, but they kept the coupon the same. So there was a transfer wealth of billions of dollars from the poor little lender schmucks to Billy Ackman. So I mean, it was unbelievable. I mean if I had done an array of outcomes, that outcome would have been not likely. I wouldn't have thought, well, okay, give them a year extension or 2 years, but they went like 7 or 8 years, I think, and at a rate that one would argue was not right for secured lenders. I mean, that was a holy shit.
A big transfer wealth.
Big transfer wealth.
Thanks, Barry. That's a great setup. We're only charging $35 a square.
There you go.
Thank you.
How much space do you have?
Do I get a commission?
Always 10%. Thank you very much. And we'll meet here next on March 18th on merger arbitrage, and Brett Barth is moderating. Ted?
Very soon.